Hello and welcome to the Market Bull podcast. Please note, topics and stocks discussed in this podcast are not financial or investment advice. Today on the show, I spoke with Keith Della-Vedova, a representative and corporate manager at CPS Capital, which is a Perth-based boutique corporate finance and stockbroking firm. Keith started by dissecting the recent lithium movements globally and tackled the news from Chile about nationalising the lithium sector. We talked about the lithium spot price in China, some of the recent quarterly announcements from Tier 1 companies, and then shifted our conversation to other areas of the market that will be looking to accelerate over the coming months. We looked at seasonality factors in Northern America and what this means for the second half of 2023. I hope you enjoy listening. So hello and welcome to the Market Bull podcast. I'm your host, Ben Kostrich, and bringing back a regular guest of mine every month is Keith Della-Vedova from CPS Capital. Welcome back, Keith.
Yeah, I feel like I'm becoming part of the furniture around here, Ben.
Literally, I mean, you are. You're sort of my go-to regular, and you messaged me literally a few days ago, sort of saying, yeah, it's time to talk about lithium again and what's been going on in the markets because, yeah, already, as expected, so much is changing month to month, and especially in that sector, but all over. So give us a little update on what's happening in the lithium markets across the world.
Yeah, I think the reason I messaged you was obviously with the news kind of coming out of Chile recently. There's a lot of questions going around. What does this mean? How does this affect things? And what are the domino effects from there? So, yeah, I guess the announcement from the Chilean government regarding, people are calling it nationalising. It's not fully nationalising it. They're still honouring their contracts with SQM and Albemarle, who, they got contracts until 2030 and 2043, I believe, which they said they're not touching. So anything existing is okay, but they're saying in the future, they want to partner with anybody that's doing any business. So, whilst it is kind of partly nationalising, it's already happened for the copper industry for them. So, they're just kind of following down that route. What that means, I guess, is it becomes a little bit more risky. You mentioned the Albemarle share price and the valuation has come off something like $9 or $10 billion. It just means the market doesn't like uncertainty. And whilst there's uncertainty around what's happening in Chile, the market will de-risk those sort of assets and won't account for, the full valuation there. And I guess going forward, it probably does have a bit of a jurisdictional risk for a few people. If you have to deploy billions of dollars in development costs and, potentially down the track the government could change or, they could reintroduce more laws, then that's something that these developers and will need to take into consideration going forward. So it's not something they can just go, yeah, happy to go, that's an easy country. And then I guess that opens up the priority to other jurisdictions.
Well, because the Albemarle price, I noticed it's come from, $290 a share with a market cap of, $33 billion all the way back down to $21 billion with a lot of this noise, a lot of this sort of buzz about this Chile sort of evolution with nationalising it. But would you say that's more of like an overreaction from the market, or do you think that's generally the future now for companies to have to really reconsider sovereign risk as a potential factor naturally with this movement now in Chile?
Yes, sovereign risk is a big part of it. Bolivia is another one where it's got huge lithium resources. It's in the same boat, and this is just the what investors are feeling. Are there other investments out there that are producing that are of less risk from sovereignty? Some of the ones in Australia or in Canada or elsewhere are probably potentially a better fit. So that's why the market is de-risked there for those two companies. They're still printing money. They're still increasing their production, but the market and investors just don't like uncertainty, and that's what's happened. So, and people are kind of de-risking a little bit across the lithium space in general. We've had a bit of a jump since the I think last time we mentioned the Liontown takeover, and that was trading about $2.45, and now here the Liontown price is trading at $2.75, which is 25 cents above the $2.50 takeover price. So it just means investors are willing to predict that there'll be a higher bid because Albemarle really want that asset. Is that because it's in Australia? Potentially, that's a jurisdictional. Which is safe, I guess.
Yeah, well, and that sort of feeds into me with all this news coming out of Chile. Almost the Albemarle takeover of Liontown almost gets a bit more attention from their point of view because suddenly, they're trying to relocate their future. They're understanding that there's going to be some changes, and as you said, it's not really till a lot of years down the track, but even still, they're strategically trying to think of safer jurisdictions like Australia, Canada, and North America, for example. But I mean, when we're looking at that, it's hard to say when we think they're going to come back. But I mean, surely that's going to be a note again for the lithium space, that the attraction towards these safer, secure jurisdictions is now going to be heightened because of a lot of this noise and activity.
Yeah. And, another highlight of it is Mineral Resources blocking stake for the scheme of arrangement ESS, It would all look like it was going through. Mineral Resources bought their stake on market and they blocked the scheme of arrangement. That was meant to be at 40 cents. The stock's now trading at 44 or so. It just means that, the majors are being more strategic about where these deposits go, especially when they're more advanced. They're going, okay, you've got a resource, what's there, what the grading is. So people just aren't letting these things go for cheap. So it is becoming a bit more of a bit more like chess for developed or more advanced deposits in jurisdictions like Australia, Canada, and the US, even Africa as well.
And I mean, diving more into that, I mean, have you noticed any particular companies that have really been thriving? I mean, last time we spoke, the lithium sector there was seasonality factors. We talked about Tesla and the Chinese sales as well having an impact on it, and there's a lot to digest there. But what have you noticed really start changing now? And I mean, looking forward with seasonality, I've heard it quite a few times, sell in May and go away, and these terms that are thrown around. Do you see that having an impact of where we're going now, and just what you've noticed over the past month, at least since we last spoke?
I guess one of the things that's changed is and for some reason it's a really telling factor when it really shouldn't be. The spot market of the Chinese it doesn't really make a lot of sense, because when you look at the quarterly earnings from the PLS, the MinRes, the Albemarle's, they're saying they're getting really good contract prices, which are significantly higher than what the Chinese spot price is. And I think probably in the last kind of couple of days, 3 or 4 days, you've started to see the uptick in the Chinese spot price. And you've got to think a lot of the investment strategies as well, which probably people don't realize is tied to, hedging across certain products and certain trades. So let's just say hypothetically there's some strategies out there which are shorting the lithium price because it was too high. In turn, after that, they go ahead and they short the stocks in the lithium market, which means they've got a back-to-back piggyback trade on their short position. Now the price has started to turn, in the lithium spot price, people will start to go, okay, well, the shorts are starting to get a little bit squeezed as well, which means people will start to unwind their positions in the stock market as well, in the equities positions that are short. So, and a prime example of a short squeeze was when the takeover came for Liontown and everyone had to go ahead and cover.
Yeah.
So, I think that people have got to realize that there are investment strategies out there that are designed for prices to maintain low, and eventually that sentiment will come, and then people will have to close these positions in the market.
I mean, it's a little bit off topic, but with shorting, can you break down what that actually means in regards to, pretty much prioritizing or in a way hoping that a company goes down or a price goes down? Yeah. What is the
It's
process?
Actually a funny one, because you see this a lot of commentary of people talking about, Goldman Sachs or Credit Suisse or State Street, they've taken a stake in this lithium company and, it must be a good thing. If you go through, the agreements when they become a substantial shareholder, they're actually loan agreements. So what will happen is the custodian, they'll have a client, Goldman Sachs, for instance, will have a client that wants to go short the stock. They'll go into the market and they'll get the stock. They will then have a loan agreement to that particular client who's then shorting the stock. They're selling it. So they don't actually own the stock at the time. The custodian will go in there and acquire the stock. Their loan agreement will give it to the company that's looking to short it. The company will then start selling the stock. So they didn't have the stock. They borrow it off someone, and then they sell it into the market. And what they do, their idea is to buy it at a lower price at a future time.
Yes, I'll come to almost manipulating the outcome of a stock or a commodity or even a share.
Again, it might be tied to the people looking at the lithium price. They might have a short on the carbonate price in China, and then they're going right to go with that. We're going to short some of these lithium stocks as well. So they'll have to go borrow from from one of the major banks, and then they can repay that at a later date once they've achieved their sort of set price. And it's happening across lots of the once they're included in a certain index, the hedge funds love it because they can go in there and take a position and then start shorting it. It just kind of typically happens once the guys go into the ASX 300 or 200. But yeah, it's actually quite interesting. People kind of saying that Goldman's have taken a stake. No, Goldman's don't have a props rating test. They haven't done that since the GFC. So what that actually means is that if you go through the statements a bit further, there's yeah, their loan agreements in there, and people are shorting the stock. So
Interesting.
it's something that it just remains quite funny when I see people seeing that.
Exactly. Well, and it's the surface level of it is everyone thinks, oh, they're buying the stock, but when you actually dig deeper into it, and I was watching an ASX webinar yesterday about options in particular and shorting and all this, and that, the everyday investor might not be able to get access to it, but you just know these big players are doing this all the time because that's where really all the money is made. And in a way, they've got very limited risk in some aspects, but they're making ridiculous returns out of it or setting it up so that they can strategically buy into it. And I mean, I think it was last time China, especially with the spot price, there was some sort of floor put in. Was that from the government, or where was that?
They were talking about it. It was more of a rumor rather than a fact sort of thing. But what you've happened in China is the lithium refiners are mining lepidolite, which is a lower quality of kind of lithium, and they've all, now the prices come down, they're not actually making any money. So what's happened is those guys have all shut down, which means there's less supply out there. Yeah. So again, it's too early in to kind of see that the Chinese spot market is actually making a difference. But you can see that there has been a bounce in the last couple of days of lithium stocks on the back of the lithium spot price in China kind of going up. So it's a weird one. When you look at the quarterlies of a lot of the majors, they're getting contract prices significantly higher than kind of what's going on in the spot price. So there's definitely, for the big guys, people want security of supply. They don't have to go to the spot. They prefer to get security and pay that extra little bit of a premium to make sure that they've continually got it, because we still see EV demand and car sales outstripping supply of lithium anyway. So there was Elon Musk tweeted the other day for the US in particular that they currently produce like 20,000 metric tons of lithium carbonate equivalent at the moment, and they need, by 2035, they need 35 times that.
Yeah.
And, lithium, I think I've mentioned this before, lithium mines don't just come online in like, a heartbeat. They can take between, 8 to 15 years to kind of potentially get online. So, yes, whilst there is a bit of an overhang in supply at the moment, the demand will continue to outstrip, and it's just going to go in cycles for a lot longer.
And I mean, we mentioned it before going on air with Tesla and even the Inflation Reduction Act in America and what that's going to start having potentials in the lithium space. I mean, what developments are you seeing there already over that short period of time that $360 billion is that checkbook is opened for companies and even free trade agreements with the United States? Yeah,
there's a bit of a price war going on with the car makers at the moment. You can see Tesla lowered their prices just recently as well. And again, bringing them down brings them into that Inflation Reduction Act tax credit, which is $7,500. People will be getting a rebate on. So I think there's a lot of jostling around to make sure you're within that, because then that's going to be, you're going for volume. Then everyone's going to buy a car in that bracket because they know they're going to get a $7,500 rebate. So I think what we're seeing is a tussle for market share, I guess, at the moment. And I think we'll continue to see that. And a lot of cheaper cars are coming out at the moment, so they're all going to fall within this rebate place as well. And as these milestones of phasing out combustible engines get closer, people are just going to be forced. You're not going to go, oh, well, I'm going to go out and buy a combustible engine car when I'm not going to be able to kind of use it in 5 years or 10 years.
Yeah.
People are just automatically converted. I think they're saying even in Australia, 1 in 5 are electric at the moment. So.
Yeah. No, and I was going to say, it's like the whole adage that, as soon as you start reducing the ability to get access to it, people just transition. I always think back to the shops, for example, when everyone had the checkout counters and then all of a sudden these machines came there and you had to do the self-checkout and this massive sort of hesitancy. And I remember my dad would hate going towards these things. He just got so frustrated with it. But now it's almost like that is how you shop. You don't ever see someone at the counter. I mean, it's a bit of a stretch to compare that to electric cars in a way, but you can just see that as we do quickly get to this EV future, that getting a diesel or a gas car is almost going to be harder to source, and it almost becomes a luxury or a unique ability to have one, because everything is going to be built and incentivized for the EV trade. And I haven't necessarily looked at all the stats with how much these cars are making comparatively to their traditional methods, but I can imagine that is very quickly swinging. But it all falls back to where the commodities, where the mines, where the resources. And these companies, as we say, with huge checkbooks, are just getting ready to acquire and go ballistic with it.
Yeah, and we're finding in the cycle at the moment is for, again, going back to the takeovers, and that is everything's come off. So whilst everything was peaking the last couple of years, prices were high, valuations were high. They've all started to come back, and this is where we're starting to see the M&A activity come up, because the majors go, right, well, now's the time to buy when things are cheap. So let's go out there and let's do some acquisitions, and you'll see some consolidation in spaces. You'll see some deposits that are picked up because it's cheaper than what it was a couple of years ago. So again, strategically acquiring some of the assets in the right regions, the big guys come out and do this at a time where companies are vulnerable. They're trading off their highs. And it's not just in the mining space, but you look at Silk Laser Clinics getting acquired by Wesfarmers, for instance. This is just that part of the cycle where valuations are cheap, and clever people will take advantage of that. So,
I think that's almost goes without saying that all these fortunes have been made where the reality kicks in that some companies are in an unfortunate position. It's almost just the natural progression, and that the market cycle is that these companies that are looking for lifelines, it almost becomes the only option. And then these companies that have incredible checkbooks and incredible resources available can just come and take it, and then 5-6 times increase it, or even more, the value of the share. And I mean, that is definitely the phase we're looking at. And it goes back to the Liontown acquisition, and there's no shortage of other noise in the lithium sector. But we were talking beforehand about North America in particular and the changing season. I mean, what is that going to have a role in the exploration side and even the activity within the North American and Canadian companies?
I think this is quite important for the juniors that have recently acquired assets or state claims in North America during winter. They probably haven't been out there and done a lot of field work. So I think, between like May and sort of October is when you can really get out there, and starts to become summer. You can do your field work and, do your rock chip sampling, send people out, fly your helicopters and whatnot. So, that's only just going to start happening for a lot of the juniors now. So we should really start to see a lot of news flow come over the next, 3 to 6 months, which should be good. I think a lot of them have, got that initial euphoria of, we're near, Patriot Battery Metals, we're near Winston Resources, they're basing on neurology, but now the first field season's coming out where they can actually get out there. And, again, so in summer in Australia, people typically drill, but over in North America, you typically don't drill in summer because it's too soft to get the rigs out there. So, whilst they'll go out there and do their field programs now, identify the pegmatite outcrops or whatever they can find, they'll identify targets to go out there and drill. The drilling probably won't happen between, December and kind of February, March next year is when the drilling will start to happen. So, you're really only just starting to get to the crux of when results and that'll start to come out. So, yeah, I think it's going to be a real interesting kind of season coming up for a lot of juniors. There's a lot of satellite imagery work being done, identifying, pegmatites. But until you get on the ground and you really start, doing some real work out there, it's very speculative. And you can see a lot of the companies that ran up just on acquiring have slightly come back, and capital's a lot harder to come by now as well. So people are looking at quarterly statements going, right, drilling costs this much, staff costs this much. Are they going to have enough for the next 6 months or, 12 months? Or, are they going to become raised in the market at some point? So a lot of people are really assessing, where these companies are truly at. And again, you can see a lot of them have come back significantly in valuation.
Yeah, well, it's such an interesting point about the weather, for example. I don't think many people or many listeners would even consider that, the weather in Australia is pretty good almost all year round, and you can operate and really get a lot of hands-on activity happening. There'd definitely be moments where you can't, but America's such, or United States and Canada is such a different jurisdiction, or even other parts of the world, you can't necessarily be out on the field all the time, which again extends these timelines and continuously say the shutdowns for mines, and now we're still feeling the effects of trying to get these processes up and running and even just resuming where projects are. And of course the cash implications are huge, and companies are now they're in that balancing act of, can we go to market? We're diluting current shareholders. What's in the best interest of everyone? And I can't imagine it's an easy job.
There's less capital to be deployed at the moment as well. I think it's been our quietest first quarter ever, I think. So, people aren't just kind of handing money out left, right, and center. Mm-hmm. So you've got to be kind of strategic about who you're selecting and whether the money can be done. I have seen a couple of junior resources companies acquire or kind of get ready for a field season coming up in the North American market. And they've got the smaller raises away between $2 million, $3 million. It's been quite easy. But as you mentioned, Latin Resources went out for $37 million, and I think that was at a 0.5% discount, and they got it away, and it's trading at 20%, 25% above that price. So, I guess it just depends which stage of the cycle and where your assets are. But there is still more to come, I believe. Discoveries will be made. We're still only in our infancy. This is a decade-long sort of cycle, but you will have its ups and downs. The price will go up, the price will go down. It's going to be an interesting kind of 6 to 12 months, I think.
Yeah. And I mean, looking forward, I mean, what's going to be the most exciting factor for you? I mean, I touched on it, and I saw another article today in particular, like AI, and sort of the ramifications and the issues involving that. And I saw there was a heavily involved executive at Google, I think, has just come out and resigned and saying the exact thing, that he sees a real fear in that market. But I mean, do you see there's other opportunities that are really going to take off in the next sort of 6 to 12 months outside of it? I just see AI as one of these ones that it's taking off exponentially quickly, and there's calls to sort of halt it because we've got this fear about who knows what we're unleashing on the world. But what else are you seeing moving in activity outside of commodities?
I'll stay in commodities. I think another one is copper. Is probably another strategic one. Is quite sought after. Gold's been doing quite well. So I still think they'll have their day in the sun, and good results will get rewarded in the market. Outside of the kind of mineral sector, I just recently did a deal in a sweepstakes casino company. Social sweepstakes gaming.
So what do they do?
So there was a company sitting in this very boardroom actually back in 2013 called Virtual Gaming World. I'm sure you've probably heard of them before. Yep. And we listened to the presentation. I think the valuation at that stage was about 100 mil Aussie, or 10 cents a share. And we thought it was crazy. The company was valued at 100 mil, was making no revenue. We passed on it. And you look at that story now, they're probably undervalued at $5 and $6 billion.
Yeah,
which is why they're kind of doing a shareholder buyback at, I think it's $6.50 a share. So, and they've been paying dividends. They paid out like $3 in dividends over the last kind of 2 or 3 years. So people have made their money back. They've got their position still. They can do the sell down. So that's just a learning curve for me, I guess, from investments. You always don't make the right decisions, but what do you learn from it? Had a client of mine who's developed something similar and actually made money in the whole VGW sort of wave and euphoria, which has been great. And just kind of backed these guys in. Good couple of founders, young kids out of Miami. And I'm really kind of excited about, I guess, not just the tech space, because I think the valuations, I touched on it last time, have come back. But I think luck-based gambling actually becomes more of a thing in times of recession, because people think if they kind of gamble that little bit, they can make their way out of any sort of financial problems that they're in.
Yeah.
So we took a little bit of a risk, I guess. We did 3 months worth of due diligence.
Yeah.
But it kind of took a stake in this company, and they're about to go live, mid-May, I believe. So it'll be interesting to see kind of how that goes, and how their launch goes, and what problems they run into. And how much traction they get, because it's a North American thing. But we're hoping that kind of follows that sort of trajectory that the VGW has gone on, and the US gaming market and sports betting market. I think the other Aussie company, well, not Aussie, but it's stake.com. I think everyone's quite aware of. I think they're doing 120 million EBITDA per month and growing continually. So that's kind of why I'm looking at a few of these. There's another one out of the European market called Pulse, who do about 250, 300 million rev. They only started 2 or 3 years ago.
Yeah.
So kind of, again, getting set in a valuation of a company very early on and doing an initial seed round, working with the founders. I'm excited to see where that goes as the cycle progresses. And, I'd like to think we're probably at our low points at the moment, and, the market will start to kind of track over the next couple of years. So getting set early and, developing a company and getting it to a stage where you can get an exit. I'm quite excited for that prospect. So that's kind of my venture off into the technology space for now, and I think it'll be an interesting company to follow over the next kind of 6 to 12 months.
Gotcha. Yeah, because even going back to some of the US stocks that, even we touched about it in earlier chats, that had been smashed and their stock price have come down. And then, I don't think, in times that have been a bit rough, people necessarily turn a blind eye and look away. And there's actually been some really positive returns in big companies like, Microsoft, Amazon. They've all bounded off their lows. I mean, they're, you could say, almost market darlings, but that's the top line level that a lot of these companies that have been smashed and people have ignored potentially from the March, February time, have in a way missed out on these emphatic rises. And I think that's it's a state that the market's still iffy. Interest rates are still that looming cloud over people's heads. There's the talks of inflation still, but I think that's sort of simmering. And as you said, there's the mergers and acquisitions, but then it leads into the next stage, which is, the IPOs come again, the ease and ability to get capital starts opening up. And I mean, that's sort of my ambition for it. But again, it's sort of unprecedented times. No one really knows what the outlook is kind of looking like.
The Nasdaq's the best kind of performing sector so far this year.
Yeah.
So it has bounced back, and I think if you crunch the numbers, which a lot of the analysts have across the investment banks, you'll see a lot of companies have shed what I would call fat from their balance sheets and from their staffing. Do we really need to do this? No, probably not. So they've trimmed right down, realized capital is not easy, capital is not cheap anymore. So they turn themselves profitable. They've gained their market share when borrowing money was cheap. Now borrowing money is expensive. They trim down, they become profitable, and that's where you start to see the share price increases going. And earnings season so far in the US has actually been quite good. You've seen a few people outperform on earnings per share and revenue wise. So I think that the tech sector will continue as there's still people cutting staff now, and you'll start to see these balance sheets start to look a lot healthier and really start to probably turn some profits, which previously they were just aiming for growth and capture of the market, and it's okay, we'll turn profitable in the future. Well, now is that future, and this is when I think you're going to start to see some really good kind of changes in the tech sector.
Okay. And then, I mean, we touched on it, or you mentioned it just before, the gold and copper in particular. I mean, gold, even last time we spoke, we're still sitting around that breakout zone. It's almost in a way accumulating or just pausing. I've tried to follow gold for the past, 2 or 3 years and can never quite pick it. I don't think many people have, but it's always been in that weird sort of element. I mean, what do you think is going to be the catalyst for that to potentially break out, and what is that going to then feed into the junior explorers, the big tier companies? I mean, Northern Stars, but then of course lower down the chain, those smaller companies that are in that space.
I think a declining US dollar will definitely help the gold sector. So the US dollar's kind of strengthened a lot recently. So as that starts to come off a little bit, as they potentially start to cut interest rates in the US, they're already starting, a lot of the inflation figures are really starting to fall off a cliff. So, we'll see what the Fed does over the next couple of months. If you start to see a decline in the value of the US dollar, we'll start to see gold go up, and that will probably what sees the breakout happen, I guess, at the end of the day. So, I think that's the catalyst that'll, push it beyond. It's sitting around 2,000, it's chopping, it's trading, and hasn't really broken out of this range. So, I think once that happens, we should start to see a breakout towards the 2,100, the 2,200, and, it obviously has a positive effect on a lot of the producers making better margins. A lot of the companies that had assets that weren't profitable previously start to become profitable. So I think you'll see an increase in people building mines based on the fact of a higher gold price for a longer period of time. So and you'll see discoveries kind of start to come. I think we're already seeing a few IPOs sort of come through. I think we've got one or two kind of coming in the Africa region, which is quite exciting. The African place seem to be doing very well at the moment. So
yeah. Well, and that's the whole idea for me is thinking that gold has been accumulating. It's been bounding off almost a triple top where it's approached this all-time high 3 times, and as soon as it breaks out, I mean the obvious question is how high and how far can it run, and that's the exciting bit. I mean, historically looking at when gold's broken out of channels, at least in the spot price, it's had this emphatic rise, and it's just been a matter of you just enjoy it until naturally it accumulates again at a certain level. But I mean, sitting here, it's hard to see, but I mean, it's going to be great. I mean, if the US dollar comes down, that's also amazing for Australian gold producers. But there's so many factors that is going to be so good for not just Australian but for entire gold producers. But then I mean, shifting to copper as well. I mean, I spoke with Jack Sedgwick last week from Casilla Copper. And we talked about the outlook for copper, which again has got to have an incredible run based on EV and even the current cycle of it is so vastly different to where copper has been before, which gives it a different, again, flavor. So where else do you see that going that you mentioned earlier?
Yeah, I think we're seeing declining grades in the places like Chile and Peru as well. They've got through a lot of the high grade stuff, so you're getting lower grades, which is a lot harder to process. You're seeing social unrest in countries like that as well, which lowers the production. And again, with the whole EV thematic and decarbonisation hasn't abated or anything like that. It's not as though we don't need more copper, lithium, nickel, all that sort of stuff. We still do. We're just in a different cycle of economically, I guess, through that was different to the last couple of years where interest rates were low. So, these things are all still going on in the background. It's just, it'll take a little bit of time for the cycle to come back. And we'll start, there was an article in the Wall Street Journal, I think last week, saying, this will inevitably lead to a mining boom. So we're still in our infancies of a mining boom. Once again, the economic cycle comes back and starts to roar back, everyone starts realizing, hey, actually we need more mines. We need this, we need that. It hasn't caught up. We'll start to see a lot more increases in prices and valuations. But again, going back to why the majors are starting to use their balance sheets and their structures to acquire assets whilst they're cheap, because they already know this is happening. They're being very strategic about, copper, for instance. You look at the Oz Minerals, BHP taking that. So, you're looking at those guys just acquiring things, plug and play, and go, yep, we're going to increase our production because we know in the future that the prices are going to go higher. But they do all their groundwork whilst, sentiment's low and valuations are low. Buy low, sell high, I guess. The stock market.
Yeah, well, and they're in a fortunate position where they can afford to do it. I think, the everyday investor naturally doesn't quite have the same ability just to go and do it.
Everyone that I talk to seems to buy high, sell low. So it's
exactly,
definitely opposite.
Everyone's very good at that, and then you see, that's why the masters of the trade do exceptionally well, and they can, as we've talked about, remove the emotional component of it and just look at all the fundamentals, the tailwinds, and really have a strategic outlook. And yeah, I mean, it's a bit easier.
There's good things out there. There's a couple of things trading, at or below cash. It's funny, the whole SPAC market has kind of really fallen in a heap, and over here we just call them shells, right? There's listed companies with cash and assets. They're looking for a new asset, but some of them are trading below cash backing. So eventually, at some stage, they will acquire a new asset. They will do something with the listed company, and they'll go on a run from there. So it's almost kind of, if you can find these companies that are, looking to strategically acquire something else, they've got cash, they don't need to do a raise in the market. There are good bargains out there to be had, and you just have to be patient.
Yeah.
It's not all going to happen like it was the last couple of years where things were just moving and running and everybody had money in the market. All that money that was there has kind of been taken out, and people are offsetting mortgages, or people are using it for the cost of living. So that free money that people once had, they don't have that at their disposal anymore, which is effectively the RBA doing their job correctly.
Yeah. Well, it just goes back to, a lot of people had a lot of fun in that, 2020, 2021 rise. And then that, we've talked about that shoot down to the negative, and people have naturally had to tighten their belts and readjust what they're doing. But then, the underlying premise is that there are still these needs, the demand is still there. It's still going to start increasing, and what is already increasing, it's just about, if you're in a position that you can capitalize on those returns and that future growth. But I mean, this has been an excellent discussion. I mean, we've ticked over the usual sort of landmark. I mean, I wanted to touch more a bit quickly on the banking sector. I don't know if you've got some information to shed on that. I know particularly with the US with the banking issue, but have you got any thoughts on that? I think it was the JP Morgan taking over
JP Morgan just took out First Republic again. They actually not meant to be able to. They actually adjusted some laws to be able to take it out. They were just bad decisions. I think that some of the chief risk officers at these companies didn't adequately take into account interest rates going up so significantly. So just poor mismanagement of balance sheets at the end of the day. A lot of the banks are fine, the regional stuff, It's just a couple of them that really didn't do very well at it. And it shouldn't really be happening, but I guess you learn, and the banks are in a better position today. Like JP Morgan just can keep absorbing these, and they've got a process that this happens. This is what we do. We don't let the crisis of previous. That's why there's not a lot of volatility in what's going. You look at the VIX, which is the volatility index.
Yes.
That's at 16. It's kind of at you won't wake up really and see 1,000 to 2,000 point drop on the Dow, So you can go to sleep at night, hopefully knowing the fact that, there'll be some sort of volatility, but the VIX being so low, they'll always kind of come back in and buy the market. But I don't think it's a contagious thing. No, you even heard Jamie Dimon, the CEO of JP Morgan, said, we don't see this as many other banks having this problem. So, we're happy to see that the banking crisis is effectively over. Yes, there might be two more that have got, a bit of an issue, but we don't see this happening to, 20, 30, 40.
That domino effect.
Yeah. So I think, it instills confidence in the market that someone like that coming out and saying, we're pretty kind of happy with where the banks are at. They've obviously got a little bit more knowledge than what you or I do. So, I think it's probably definitely blown a little bit more out of proportion than what it needed to be. But I guess they learn and they'll regulate, and red tape will come in, and you can't do this, you can't do that, which will make sure this doesn't happen again in the future. So, whilst there's a bit of chaos going around, you always live and learn. And again, markets are still bouncing. So whilst there has been this turmoil and volatility in banks, the S&P, the Nasdaq, the Dow, they're all still up for the year. So, where are they going to finish? We had such a bad year, last year where we were down. Typically, I think I mentioned in my first podcast, we go on a 1 or 2 or 3 year kind of, it's not going to go up 100% straight away, but over that period, you may be able to increase kind of 30 to 40% on the back of a really kind of black swan event.
Yeah, no, exactly. I think it's, the banking sector with these JP Morgans, and even thinking back to UBS as well, taking over Credit Suisse, it's another example of, absorbing badly run companies and unfortunate positions. And, it's easy to say it from this position, but it's just good from their point of view.
Credit Suisse should have gone a long time ago.
Yeah.
Like it was badly run for years and years. And
since the GFC, really.
They should have let it go a long time ago. It's, oh no, we'll keep it going. Going. But, they consolidate, someone else comes along, someone else gets bigger, and the industry's moved on, which is good to see.
Yeah. Well, no, thank you. It's been a comprehensive update on everything that's happening in the markets. And I know I'll be getting you back probably in the next month to touch on what's been changing, because, naturally, everything evolves so quickly in the markets. And, thank you for taking the time to speak with me on the show today, Keith.
No, mate, always a pleasure. And looking forward to the next one, hopefully with a few more takeovers or movements in the lithium sector.
Some exciting changes and acquisitions happening out there. Yeah, no, great. Beautiful.
Thanks, man.
Thanks for listening to the Market Bull podcast. If you enjoyed it, please make sure to like and subscribe. You can follow the Market Bull on our socials at Twitter and LinkedIn by searching The Market Bull. You can also subscribe to our newsletter on the website by visiting www.themarketbull.com.au.